But if everybody who had their money in the bank went up to that buffer amount and asked for their money back, the bank does not have it because they have it invested in.
Hey guys, welcome back. Today on Building Your Wealth, IBK and I are going to be having a candid but very interesting conversation all about
What money is.
Yes, so we're going to be talking about what money is. But before we get into that, if you are not subscribed to this channel, make sure you hit that subscribe button. We post videos every week, so you don't want to miss it. Also hit the notification button so that you are alerted when we have new videos. Okay, let's get into it.
If I should pose a question to you guys as you think through, and I ask you to define what money is.
Yeah.
It sounds like a very simple question, but a lot of people struggle to have a very concrete definition.
I do. I can't even really give you, I just know the importance of it and what it does, but I don't really know how to define what is it. Because to me, it's just paper, right?
Sure.
Yes.
But in the past, it was calories, it was gold, it was seashells,
yes,
it was inscriptions on stone, and it was all sorts of things throughout history.
Yeah.
If I was to give my own definition of what money is, I would describe it as a method for transferring information about value.
Okay.
And if we look at it from that perspective, then we can see how for value to be exchanged, and it was an intermediary method because back in the day, people did like trade and barter.
Yeah.
I give you bread, you give me oranges.
True.
But you might not want as much bread from me as I want oranges from you, and there was always that weird friction to transaction.
Yeah.
And what money did, it was a lubricant to that transactional friction in the sense that it gave you a method of holding the value of what you transfer to someone else so that you can use that value in the future to get what you actually need, because that person might not necessarily have what you needed. Maybe you needed like leather because you were a shoemaker, but you just needed bread right now, only some bread for you to eat, but you had so much more shoes to give and you needed a way to hold the value of all the shoes that the person wanting the shoes from you wanted. So in that sense, going forward, we in recent times, we've had a transition from like the gold-backed currencies that we had, where in the US, especially after World War II, the dollar was pegged to an inventory of gold in vaults. And so there was an exchange rate of $35 an ounce, $25 an ounce. And if you look at the old dollar notes, it said, this is a voucher along the lines of this is a voucher where you hand it to the Federal Reserve, which is the central bank of the United States, and they could give you an equivalent amount of gold in return. And so what this provided was a system of scarcity, because why gold was so important and has stayed as an equivalent money for a long period of time is because for every gold bar or every piece of gold that is around, there had to be some work done behind it. So somebody needed to go and mine the field and expend energy to do that, or somebody provided value to somebody else for an equivalent exchange of gold, or the last item is you just stole it. Okay, so those are the three ways you can hold gold. And innately, everybody knows this, right? If you see somebody with a bar of gold, it's either they bought it, or exchanges something of value for it, whether it be time, skill, or they stole it, or they put in the work to actually mine this gold and create what you saw.
Sure.
So, we had that system, and it created some checks and balances around the government and how they, created money and worked through the system. But unfortunately, in 1971, the U.S. government and, the rest of the global economy decided to get away from a gold-backed system and go to a fiat system. And to define what a fiat system is, it's a method, like fiat means by decree. So the reason the dollar and the dollar notes and bills in your bank account and that you hold in your hand have value is because the government says so. That is the only reason
it's like a societal everybody has agreed.
Correct. This has value.
Yes. Okay.
And the issue with those kind of centralized systems is the fact that you have a few people who control the supply of money, and they can now decide how much money is created, how much money is in circulation, as opposed to having a completely separate system that nobody had control over.
Gotcha. And so
Go ahead.
So that brings me to a question about inflation. Like right now, obviously, we hear a lot, oh, inflation, things that cost like groceries used to cost me $200. Now they cost them $400. Like, let's talk up. Can you kind of talk more about inflation and how that ties into what you just said?
I would love to. And to do that, I would love to back up a little bit and get to the point. So let's take an example of wars. Back in the day, you could never have the length of wars that we had, let's say when we, were fighting terrorism. I think we were in Afghanistan for like 20 years or something like that. If you look at World War I, World War II, those lasted like 3-4 years and they wrapped up. You know why? Because there was a limit to money was pegged to gold. And the only way to create more money was to mine more gold or to tax the existing inventory of paper vouchers for gold so that they could raise the funds to fund the war.
Okay.
And so when you depeg from that, the government no longer really needs our tax dollars to do what they want because they could just create based off a debt-based system, money to do everything that is out there. And so that is why without them increasing taxes on us or our buy-in, we could fight a war for 20 years and, there was no repercussion to us. Back in the day, if they started taxing us too much for the war, people would be like, yo, okay,
calm down.
Let's all come back. Let's figure out a way how to do it without fighting and all that. So it pretty much centralized the power around the government system. And so when we start to think through that, going back to inflation, because of a centralized system, there is an opportunity for like market manipulation where the centralized entity that control the flow of money decide where they want to add money to.
Yeah.
So I'll give an example. During the 2008 financial crisis, there were banks that were going under.
Yeah.
Some were allowed to fail and others were not.
Yeah.
The government decided which ones they were going to save that were too big to fail and had systemic risks to the global financial system. And so they saved them. And you know how they were saved? There was through strokes of keys that were ledger entries into their balance sheets that provided them the liquidity to continue operations at no detriment to those banks. And some of those banks were even able to buy other banks that were going under, and it was just a consolidation of power into some like oligopoly around the biggest banks here. And so when you talk about inflation, like why do we have inflation? When the government decides that they want to add or they want to support an initiative, let's say
like COVID.
Exactly. So I didn't want to mention that, but let's look at COVID now. In my opinion, and I will say my opinion, do have some facts to support this, but let's put it my opinion. One of the main reasons why we're having inflation today is it started off with 2020 was the first time that the government handed checks directly to individuals as opposed to give in the past, like throughout the financial crisis, even though people were talking about the government printing money, money only got into the fiscal system, which is the system that me and you operate in, through them giving money to the banks and then the banks having more liquidity to lend money to the general population. And so money was created into our pockets through lending. But not all of us we had really strict lending standards and things of that nature. So not everybody saw that money equally. So people who had high credit and good lending criteria could get access to capital and the rest of us couldn't. 2020.
That's a good point to make.
Thank you. 2020 was the first time that the printed money was handed directly to the general population. And because that money fed into all our pockets at the same time, you know what we did? We balled out and we spent a lot of money And unfortunately, at the same time, where you have people now with a lot of demand, a lot of money, there was a breakdown in supply chain because of the shutdowns. And so manufacturers were not making as many things. And so things took longer, and it took more time to get stuff. And so it created, when you have too much demand chasing too few goods, prices go up, and that entrenched system of everybody expecting prices to go up has kind of fed through the system. Even though supply chain issues have kind of been resolved a little bit better now, we are still seeing inflation on our end. And so we talk about inflation. Is inflation necessary? In my opinion, this is how I would put it. Everybody understands that technology is deflationary. And what does that mean? With increases in technology, it becomes easier and cheaper to do things. Like traveling to Europe would have taken me like a month on a ship back in the day. Now with technology, we can fly to Europe in like a few hours, like 10 hours.
Less.
Back in the day, small TVs used to cost like $2,000, $4,000. Now you're getting like 70-inch TVs for like $1,000. And so with the advent and the ingenuity and creativity and increase in productivity through technology, we should be seeing lower prices on everything. Let's take real estate, for example. Back in the day, there were people who could buy nice houses for $10,000.
Yep.
And with $10,000, that was a lot of money, and people could go out there and really feel like they had a lot of money in their pocket. But now if I say $10,000, that's not life-changing money.
You can't even put a deposit on a house.
So when you think about that now, it's really not the fact that houses are more expensive to build now, because technically with the increases in technology, they're cheaper and faster to build houses now. But why are they more expensive? And it's literally just because we have so much money chasing a finite amount of goods in this real estate economy. Does that make, I know that was a very long-winded way to explain it, but does that make sense?
Yes, it makes sense. So you were answering the point of, is inflation important, or why is necessary? Is inflation necessary? I guess to conclude your argument, it is necessary.
To kind of wrap things up, inflation is the method that the central authorities who control the flow of money make us pay for the stuff they're not taxing us for. I'll give you an example. Let's say a new park is trying to be built across the street. We didn't ask for a park. Like, just for example, we didn't ask for a park, but the government just believes the park needs to be built. So they built a park. You know, you create money, right? But the labor that's going to build the park is still
Don't we
needed.
pay for that though with our property taxes and stuff? The taxes?
Trust me, the amount of funding is way more than the tax revenue that they're collecting. Every year, the US government runs a deficit, which means they spend more money than they collect in taxes. So we've been building this deficit for such a long time. And if we want to go into this, in my opinion, I believe the US or the global financial system is bankrupt. And the only way we can continue to operate is by just increasing the debt and gradually increasing the debt. I think right now we're about 120% of debt over GDP in the United States. And it's I think in Japan, they're like 200% debt to GDP and a lot of those things. Wow. So what I'm trying to get at is they spend this money to build this park, but they need to hire labor. You know, those people who work, they get money. That's jobs that wouldn't have normally been there through like typical market supply and demand get created because of this initiative that the government wants to chase. So now materials that will be needed to go into this park will need to be bought with this newly printed money. And over time, through the Cantillon effect. And the Cantillon effect is just a phenomenon where the people closest to the spigot or the source of money gets... The people closest.
Now you're just making up words.
No, I'm not making up words.
I know.
Like, the people closest to the source of money are the highest beneficiaries of the new printing or minting of money. And so gradually that makes its way through the system and we get an increase in money supply and people the people closest who are closest that, get it first, and they start to spend more, and it filters its way through the community. And that's because now you have more money circulating in the economy, chasing a limited finite amount of goods, you get inflation. So that was the point I was trying to get at.
Okay, so we talked a lot about banks. You mentioned banks a lot. Can you kind of explain like the banking system and like, I guess just explain how banks work?
Man, this is a really interesting aspect. And the first thing I would look at, the bank's business model is to take in deposits from their customers, which is your money, and then invest that deposit to create a return on the back end while they have a liability to you. So in theory, what you do when you deposit your money in the bank is you're lending it to the bank to go invest with and give you a return on that money. Now, we all know the 0.01 or 0.05% we get in interest in our bank accounts is way less than what the banks make on the back end.
For sure.
And so their profitability comes from the spread or net interest margin, which is called NIM in financial markets. So that difference between, let's say they give you a real estate loan for 5%, but then they're paying all the depositors that they use to loan that money to you 0.5%. So that 4.5% is their net interest margin. And so the way it works out is they have all the deposits, which are technically liabilities in their portfolio, and they have a buffer. And that buffer is to give you that sensation that every time you go to the bank, you can take out your money.
To the point that you just made, for example, if I have, let's say, $500,000 in the bank, I can't just I can't just go to a bank and be like, I want to withdraw $500,000. Can I? Will they give me my $500,000 on that day?
If the bank in their buffer had $500,000 to give, they could give it to you. But if everybody who had their money in the bank went up to that buffer amount and asked for their money back, the bank does not have it because they have it invested in bonds. They have it invested in like mortgage-backed securities, which will be like loaning it out to people to buy real estate. They have it invested in numerous areas to where it is actually impossible for everybody who thinks they have money in the bank to get their money out.
So how does that tie into fractional reserves?
So the way it works out is they can use the difference between their buffer and their deposits to invest and create income for the bank. And that's how the banks function. But the issue with it is in a situation like now where, and I'm going to get a little nerdy, so forgive me. So we all know.
You weren't already nerdy?
No.
You about to just start now? Oh, okay.
We all know that the Fed has been jacking up interest rates over the past year. With that, we've seen it in mortgage rates going up and, lending rates going up in general. And that has really affected people's disposable incomes to be able to either afford to buy a house, afford to get a loan for a business. And it's created a tightening in liquidity in the economy. So what that does is it forces people to spend more of their deposits and reduce the available, deposit that the bank has to lend and move around.
I see.
So the way fractional reserves becomes dangerous is, I'll give you an example now. The bank is giving us, let's say at best, if you're in a really, really high yield bank account, you get 1%. But you can invest in a 1-year treasury right now or a 2-year treasury and get close to 5%. So why would I keep my money in the bank? And so you have now people like pulling out the money out of the bank, and a treasury is one of the safest investment vehicles out there. Pulling their money out of bank accounts to invest in US treasuries. What this does, it creates a liquidity crunch where the banks who have invested in like bonds and treasuries and things like that, they really do not have that money. And so it's either they sell those bonds, which have been clobbered over the last year at a loss to be able to pay you out. And if enough people do that, they go bankrupt. which is, I don't know if you guys have been paying attention and heard about Silvergate Bank and Silicon Valley Bank. Those are two banks. We're recording this sometime early March and in 2023. Those are two banks in this week who have been either decide to liquidate themselves voluntarily with Silvergate or have been completely shut down by the FDIC and taken over because they are insolvent.
Yeah.
And so there's a risk for contagion through numerous other banks if this continues and the Fed keeps jacking up interest rates.
So we have all this information. How do we protect ourselves? Like, what do we do? Because clearly, from what you're saying, it's kind of sounding like if something should happen and there's like a scare and we want to pull our money out, it kind of sounds like when we give our money to the bank and we put our money in the bank, it, like you said, we're loaning it. It really is not ours anymore. So how do we protect ourselves from, potential issues that can come out with banking or working with banks?
I would put it this way. Number one, I don't want to cause
a scare.
Yes.
No, this is not to tell you go on, take your money out. No. Banks obviously have their purposes, right?
Correct.
That's why we bank. I mean, to be transparent, we got money in the bank, so we're not saying do that.
Yes. So my way to protect yourself would be invest in hard assets.
Okay.
And what do we call hard assets? Assets that cannot be easily manipulated, duplicated, printed, created. Examples of these are real estate.
Yes.
Which
we talk about a lot on this channel.
We do talk about a lot on this channel. Or you can invest in Bitcoin. And we're probably going to shoot another video where we go into depth on Bitcoin.
Yeah. And not, when we say Bitcoin, we don't mean just crypto, because we're specifically talking about Bitcoin. Because I guess if you want to talk about because I feel like there's this conception, at least especially this year, maybe last year, of crypto is dead. And so I want to kind of separate Bitcoin from crypto. But
yes.
Anyways.
And so the biggest difference between, just to give a little teaser, between Bitcoin and crypto is that Bitcoin is a decentralized system that is been declared as a commodity by the SEC and CFTC and all the regulatory bodies here in the US, because of the fact that there is not one central entity operating the system. It's an open monetary system that has rules, and as long as you abide within those rules, it's not going to change, and you can opt into the system. It's voluntary. The same way, the reason why it's declared a commodity is, let's give an example of commodity: wheat or oil. Let's use oil. Oil is more.
You're gonna say weed.
No, that could be a commodity.
Okay.
It is a commodity. So the reason why wheat, or oil are declared commodities is because there is a rules-based system as to how these are generated.
Yeah.
If you want oil, you need to go into the ground, put in the work, get that stuff out. If you want wheat, you need to buy the seeds, plant the seeds, fertilize the soil, get it out. It's like a strict rules-based system. With a lot of the other cryptos, they have founders or foundations that kind of run and declare the inflation rate, the burn rate, the maximum amount, all that good
Still
stuff.
somebody controlling it.
Correct.
Whereas Bitcoin, no one can just be I'm going to add 5 more Bitcoin to the system. No.
You can't do that. And we'll talk about this more in detail in our detailed Bitcoin video, but I just wanted to give that teaser.
Which will be on our membership page, most likely. So if you're interested in that conversation, make sure you join our membership. I'll have a link in our description box below.
So I feel like making sure that you're invested in hard assets that are not easily inflatable and that you have control over. And there's a difference between the feeling of control and actually having control, because you feel like you have control over your account. It's there. You see the numbers. You know how much, if you want to Zelle somebody money, it's there.
Yeah.
But we just need to understand what the risks are. When you start to own and operate real estate, you have investment in businesses through stocks, or stocks have its own risks as well, which we would address in that video. Or you have Bitcoin. You're trying to diversify your risk.
Diversify.
Yes. away from just one central place of holding cash.
Yes.
Because cash can be inflated away.
Exactly.
Imagine that guy in like 1960 who had $10,000 and he worked so hard and he had 3 kids and was able to save $30,000. He said, I wanted my kids, my grandkids in 2023 to be able to buy the house of their dreams. And so he saved $30,000, put it in a bank, and now the trust is now available to those kids, and each one of them gets $10,000. And in his mind, he thought $10,000 would be able to buy them a house today, and it did not. So just making sure you're diversifying away in areas that are at least keeping up with inflation. Because if you're not keeping up with inflation, then unfortunately you're losing money, purchasing power. So that is the best way, I would say, to protect yourself.
Okay, cool. I think we've come to a point where we should probably wrap this video.
I think so too.
I'm looking at the time. We're at 27 minutes.
Jesus Christ.
So if you've made it to the end, if you're here still, thank y'all so much for watching this video. Again, don't forget, we make videos every single week, so don't forget to subscribe. I hope you enjoyed this video and I hope you learned something. We really created this channel to kind of share knowledge and get you thinking about money, get you thinking about investments, and build your wealth. So again, thank you so much for watching this video. We will see y'all on our next one.
Yes.
Bye.
Bye.